morning, everyone. My name is Deng. I'm a partner in the Transportation Industry Group at Reed Smith in New York. Very delighted to be here today with our four distinguished panelists. Andrew Shohet from DNB, Evan Cohen from First Citizens Bank, Erlend Sommerfelt from Oceanis, and Jason Braunstein from Hudson Structure Capital. To kick off the panel, I would like to ask my panelists to introduce themselves and their organization and let us know what sort of product their financing platform offers. So Evan, we know in 2022, First Citizens Bank acquired CIT, and this year your bank also acquired $123 million shipping loan portfolio from HSBC. Could you let us know about First Citizens Bank and what kind of products it offers?
I'm very happy to see the First Citizens logo up there. So some of you may miss the CIT logo that was around for a while, but we're happily part of First Citizens Bank, and even more happily doing the traditional business we always did at CIT. So that is senior lending, conservative, reliable for standard assets for our clients in certain geographies. And First Citizens has been very supportive of that. So pleased to be part of that new system. And we're seeing the usual business. I'm sure we'll get into that as the conversation goes. And one good example of that support has been the HSBC portfolio acquisition you mentioned. So we were able to buy some of the HSBC book in Athens, one of our core markets, and that went very smoothly. It was supported well from all levels of First Citizens, and happy to look at the next one.
Thank you, Evan. Andrew, congratulations on DNB's $900 million restructuring of the Dutch shipping company Varun this year. Could you let us know more about your current portfolio and products?
So I think we certainly offer a similar product from a more traditional kind of first lien debt product that sort of Evan and First Citizens offer. I think where we perhaps are a bit different is that I think the way that we view our sort of approach towards covering clients, I think that really is trying to offer the full corporate and investment banking product suite. So that's everything from kind of your traditional kind of first lien mortgage loans, all the way to certainly on the bond side. That's an area where we've been really active. And we offer lease financing and of course helping clients to sort of raise equity. So I think the approach that we bring towards that client coverage is more than just lending. I think that's certainly one product, but I think we like to sort of view it as being able to sort of be a bit more diverse, which I think certainly is helpful in an environment like today, which I'm sure we will get into. But when you have sort of this kind of longer, higher for longer rate environment, I think being able to do more than just provide that first lien loan is something that I think is helpful.
All right. So Erlend, as a new ship finance platform, can you tell us more about your platform and products?
We, in Oceanis, we act as advisors for ship owners and shipping investors looking to finance their assets. We facilitate debt and mezzanine from banks, from leasing houses, and from alternative debt providers. During the last summer, I mean, the pricing that we structure on this financing, that varies with the risk, but over the summer we have had low twos from both leasing houses and from banks with limited recourse in the PCTC segment and in the dry bulk segment for new buildings and for vessels on the water. So as opposed to some belief that we only work with alternative debt, we also work more than half of the volume is then leasing houses and bank financing.
Thank you. And finally, moving on to Jason. Hudson Structured Capital is an asset manager in the transportation and insurance sectors that targets mezzanine level returns. Could you please tell us more about Hudson's portfolio and the investment strategy?
So Hudson was founded in 2016 to focus on the mezzanine level of risk in the insurance and transport sectors. So we think about that as everything in between what the banks are doing and operators' equity. Last year, we also acquired a manager called Northern Shipping Funds, who's been successfully operating a lending strategy in shipping for over 15 years. So our primary product today is an asset-based lending strategy and leasing. And it's basically slightly more expensive than some of my bank colleagues up here, but competitive in terms of structure. And perhaps what we're best known for is speed and predictability of execution. Our portfolio is about $1 billion in ship finance today across basically every subsector, including offshore.
Thank you, Jason. So I would like to open the discussion on the first topic. As we all know, there is a fair amount of economic uncertainty globally, high inflation, high interest rate environment. Also this year we have seen a lot of extreme climate conditions. So my question for Evan and Andrew is, we have seen lower levels of activities in IPOs, M&A, and bank lending. So does this mean that the investment in shipping has been lowered overall?
Want me to go first?
Yes, you do IPOs.
So I think my colleague Ted just made a comment on the previous interview around sort of where the markets are relative to the sort of historical past and how strong they are. So I think that's certainly something that I think clearly I would, and I think most of my fellow panelists would echo. But I think, when you take a look at what that means for balance sheets in general, and I think particularly on the tanker side, and certainly at least in recent past on the dry bulk side as well, I think these markets, and when you look at the order book to fleet ratios there, I think there's quite a strong market recently, and I think that has resulted in quite a strong balance sheet being generated in terms of where a lot of these businesses were coming from in the past. So I think when you think about CapEx in general, and I referred to that order book to fleet ratio being where it is, I think that's largely driven by a few things. I think certainly interest rates are clearly a factor. We all sort of know about that. I think that when you look at a lot of the discussion around alternative fuels, the energy transition in general, I think that has, of course, created some uncertainty with regards to new build orders, but perhaps that is changing slightly. And I think that ultimately, when you look at the capital markets in general, there's clearly a lot of geopolitical factors that are taking shape there. Unfortunately, this weekend as well. But I think that generally speaking, there has really not been a huge need for many of these businesses, and especially when they're doing so well, to have to actually go out and hit the capital markets and raise capital to fund some of these projects that may potentially get pushed out.
Yeah, thank you.
And I think we're on the other end of the spectrum. So our biggest problem has been with all this cash getting repaid. So a lot of the senior lenders, or a lot of the capital providers face that. So ship owners have cash and they repay us faster than normal. It's always nice to get repaid. And so it's a luxury problem. But from the larger macro point of view, there's still the same number of ships on the water. There's still the tenor of loans are still 5 years. The banks still move in and out, and owners tend to change. So there is a lot of business for us to do. So this is not for Mr. Brady, but there's an advantage to being relatively small. So at $1.5 billion book, we're looking for 20, 25 transactions in a year. There's a lot of transactions to do for us. So we have our choice of deals to do. So that's not really impacting us. It's getting repaid and finding the next deal.
Yeah, I think maybe also just to echo that point, as a bank, right, our primary business is making loans, and I think that when you've got an interest rate environment and you don't have prepayment penalties on your debt, that's certainly something that we're seeing as well.
So this year, are the companies using more cash at hand rather than borrowing?
Yes.
Okay, so thank you both. My next question is for Erlend and Jason. That's actually the topic of our panel. In this evolving landscape of shipping finance, what are the main sources of capital being offered to the market?
I mean, in fear of repeating it, what has been said at many panels and by many now, also Jørgen Lian to begin with, that overall the debt case is extremely attractive for shipping for all the reasons that have already been stated, but low shipbuilding capacity, inflationary pressure on new buildings creates natural choking of on the supply side, which is, and also the lead times makes it, it adds so much risk to making orders. LNG and container really, and some warships actually that hasn't been mentioned, is taking up so much of the shipbuilding capacity. So it's this old scenario where when you don't, the banks are all over you when you don't need them, and that's exactly where we are now really. The lenders, it's overcapacity of lenders in the market, and the owners are completely dictating the terms. We've seen the owners are really struggling to fill the loan request and to make sure that they can cater for all the relationships with the banks that they want to preserve for when things get tough again. The sources of capital are pretty much the same, but we see private equity is taking market share really from banks. Less regulated, they're able to offer terms at lower margins than before, so they're really, the overlap is increasing, and we only see that going to increase further, really.
Thank you.
Yeah, I can just add that it's interesting. I mean, companies do need less debt today, given the strong earnings environment, especially in tankers, but at the same time, asset values are extremely high. So the total capital raised by shipping it's been relatively flat, but the share of non-bank lenders, Chinese leasing included, went from only 10% of the total capital raised in 10 years ago to about 50% of the total market now. So I think banks are quite conservative today in what they can do. There's been margin compression across the board, so non-bank lenders are increasingly competitive and offer a lot more flexibility. And when you look at comparable markets, the U.S. middle market, for example, there's a very institutionalized market of non-bank lenders that make up 90% of the financing requirement. I don't think shipping is ever going to get that institutionalized with the investment banks just printing product and distributing it to specialty lenders, but it is certainly heading in that direction.
Yeah, thank you. So shifting to the topic of alternative financing, Erlend, as an alternative ship finance platform, how is Oceanis working in collaboration with traditional shipping banks and leasing houses?
Yeah, thank you. As mentioned, we work as much with leasing houses and with banks as we do with alternative creditors. I think this term about calling both leasing houses and the debt funds as alternative creditors, it's becoming more and more mainstream. As mentioned, their loan products really are more and more overlapping. Alternative credit is not really as expensive as kind of it's not like the name suggested, but that's at least the common association with it. We have very good relationships with banks. We have been involved with actually developing some loan strategies with some banks, going into new regions and into to new asset classes, where we have been consulting them over the year before they've actually executed on these policies. I think we enjoy these relationships because we provide recommendations, really. So we want to be, rather than pushing any project towards the lender side, we work with lenders on long-term basis where we are asked for recommendations, and that puts us in a light where we have to be very comfortable with providing that recommendation. We can also come back to that with the sanction checks, etc. if we have time for that as well.
Yeah, oh, thank you. And Jason, so at Hudson, how do you adapt to the needs of smaller and medium-sized ship owners to finance their older vessels?
Yeah, I mean, I guess that's two questions. So first, we have an asset-based approach. So rather than focusing on specific names or recourse against larger fleets of ships, we heavily underwrite the specific characteristics of the ships that we finance. Everything from the vessel design to the maintenance quality, et cetera. And we have a team of naval architects internally that help us do that. In terms of older ships, we have a commercial approach. We look to be down to scrap levels when a ship turns 20 years old, rather than down to zero when the ship is 15 or 17. I think we finance ships of all ages, but we do like that part of the market because then you're financing a larger percentage of scrap value rather than on a new building, and scrap has much less volatility than underlying ship values.
So moving on, I would like to open the question to all the panelists on the hot topic in the industry, green shipping, decarbonization, alternative fuel. So, recently the banks behind the Poseidon Principles raised their targets in line with the IMO's goal of achieving net zero emissions in shipping by 2050. So what has been the impact of Poseidon Principles and other sustainability policies on ship finance in your experience?
Maybe I can go first. I think, the Poseidon Principles are a means for us to sort of quantify the emissions level of our portfolio. I think this is one tool that we use to do that. It's obviously a very important tool. It's something that I think we of course have lofty net zero ambitions, which we aim to achieve. And I think that this is just one means for us to do so. And I think that when we look at new transactions, when we look at our portfolio in general, I think that is certainly a tool that we use to kind of quantify the emissions. I think the other sort of trend, this is certainly nothing new, but I think it's a noteworthy trend, is really on both the sustainability linked side. So we have seen, of course, a large shift in terms of new financings that sort of implement sustainability linked KPIs, where there's an actual quantifiable target and score that can be used to sort of measure whether or not a business was successful in achieving those ambitions. And I think that there's of course a sort of benefit and penalty to whether or not those are met. And I think that that's something that we clearly have goals around implementing in many of our financings.
The interesting thing for me, at least the past year, it's the sustainability has been part of all the conversations now. So it is a normal part of the conversation when you talk to a new client or an existing client. we tend to inspect a fair number of vessels as part of our due diligence when they're onboarded and as a continuing process. And interestingly, that inspection process also includes sustainability ratings of different, more than the traditional when's the next time steel needs to be replaced. So that is just embedded now in the conversation. Yeah, and interestingly, we are also now joining some banks like DNB and the HSBC portfolio and seeing these sustainability KPIs as part of the documentation. Now, to be honest, they're not the most strict things in the world, but it's just, you're only going to add to them going in the future, not take away from them. So it's, I guess that's my message. It's just really part of the discussion now, every discussion with an owner.
I can only confirm that speaking to banks, we know that they spend a significant amount of time discussing this with all the Poseidon signatory banks. They are under a lot of internal pressure to increase their climate alignment score. I think, or it is really for onboarding of new clients. I think they face the biggest hurdles where it becomes very easy to decline a onboarding of new client unless they would increase their average climate alignment. But for the existing clients looking at new loan requests, then the existing clients have so many more levers to pull. There might be cross-selling opportunities for the bank, then the bank might be willing to forego that it decreases their climate alignment. And you can also switch and you have more some variability with regards to which assets you finance. So I think it's really onboarding of new clients, getting into the relationships with new banks where the most significant factor is seen. I think the jury is still out on the banks' side, how they're actually going to monitor and how they're going to sort of police the action plan of the owners, because this is what they will have conversations about, how to increase or to be in line with the trajectory for that relevant asset. Then they need to make alterations to the vessels, and how that's really going to be enforced. I don't know.
I'm going to jump in. So first, I hope we never gave you that as an excuse. So then we were just being polite, so that wasn't it. But for us, the owners being compliant with the regulations is first and foremost. Second, that the asset maintains its ability to earn money so the owner can prosper and we get repaid. And so we had a fellow from Cargill here, so they're not going to charter ships that are not compliant. So all these things are coming together. So we're concerned about compliance with regulations, being good law-abiding corporate citizens, but getting repaid.
Yeah, I mean, I think the regulatory environment certainly makes it more complicated to underwrite vessels and think longer term about what the commercial prospects are for certain vessels as they get older. I think what we have observed is related to the retrenchment of bank capital from the market. Banks in a business that's already facing reduced profitability because of regulation, driving a lot of banks out of the market. The banks that are left are now focused on the newest technology, the greenest technology, newer vessels, and competing even more for this small subset of vessels where still the future of propulsion is relatively uncertain. So it's very hard to get deals done on those types of vessels today with limited new buildings. And so the net effect is less capital available for ship owners.
To maybe add one point, I think certainly as it relates to the topic of green shipping, alternative fuels, we're of course spending a lot of time on that. I think certainly our approach, Jason made the comment earlier about taking an asset-based approach. I think we of course view things similarly, but I think another way that we view the world is to, and especially when it comes to some of these green initiatives, alternative fuels, is to really partner with people. I think we're a bank that's been around for a long time. I think many of our clients have been clients of the bank for certainly decades, and I think that that sort of trust that we've established, hopefully 2 ways, I think that that's an approach that we take towards that specific point.
Thank you. So I would add my own view on the impact of Poseidon principles on me. So now everywhere I go, if I see the statue of Poseidon, I would pray and pray for greener shipping. Moving on to the next topic, also I would like to open the discussion to all the panelists. That's another hot topic in our industry, the US, UK sanctions, KYC, and compliance. In light of the sanctions imposed by the G7 and other allied countries against Russia, what steps have your organization taken to increase the due diligence and sanctions compliance? And as you see that these new sanctions are not just from the US, but have spanned many regions. Have you seen an increased awareness regarding sanctions compliance from your customers?
Yeah, sure. I think generally it's safe to say we've seen an increased focus on this topic, certainly from both the bank's perspective as well as from our customers. I think there's a saying we have, which is that KYC compliance is our license to operate. I think without that, you can't do anything. So I think clearly an increased focus. I think there's a lot of self-sanctioning. You're focused on sort of where vessels are trading and with whom, and certainly sort of up and down the organization as well as on the client side. There's a heightened focus on it.
Yeah, for us it's equally focused. For us, it's been a key focus. We've moved it right up front in the process. We'll immediately do a KYC or a sanctions check. We have established protocols for all the Russian sanctions for tankers and for non-tankers, and immediately if one of the clients calls on a Russian port, we run it through the system. Being proactive about it has created a lot of confidence from our bank. So we're addressing it head on and quickly. And the really good surprise has been the clients have been very professional and efficient about it. So they'll already have their own legal report. They'll have all the cargo documents we need to see. And I have not seen it drag on. Maybe one case has dragged on a little bit, where we had to go back a second round. But it's been implemented, it's been paid attention to, and it has not been a big headache for us.
I think there are different approaches to this. With some financiers, they take a more risk-averse stance than what the sanctions on paper would imply. They don't want any of their vessels to trade Russia. So I mean, some of the institutions take more precautions than only being compliant with sanctions. As the sanctions are becoming more and more complex with price caps rather than only banning a cargo from a geographical area, it's also becoming more cumbersome to monitor and to really be sure that your borrowers are acting as per your instructions. There is also a change of the whole ship owning terrain with the Gulf region now. There are changes in the fundamental changes to where the ship owners are based and which commodity companies are actually moving the cargo. So that's another area where you need to be extra attentive. And here comes in also what I alluded to earlier, that we, in order to recommend any deal to the lenders, we of course need to understand where the money is coming from, the UBO, and sometimes there it's actually, you can say all you want about the KYC software, etc., but sometimes it's as easy as just understand the economics in how that funds have been created. In some cases, it doesn't really make sense based on what the companies are explaining, and then you need to understand that something might be off. And that might not always be picked up by sort of KYC document pushers. It's about applying common sense to understanding where the funds are coming from and the structure of the borrowing group.
Yeah, I think for us, up front, it's much easier to analyze how vessels have been trading and consider trades that we might not prefer to have in the portfolio. But on an ongoing basis is what, we're very careful. We track every vessel in the portfolio on a daily basis. So we identify high-risk port calls, ship-to-ship transfers, trends that would suggest AIS spoofing, which we haven't had, but we do monitor for it. And then we, do a detailed compliance review of any trade that involves a high-risk port call. So we look at everybody that's touched that cargo and the ownership of the cargo, up to the UBOs. We often require a legal opinion. And I would agree with Evan, it's been surprising that really all of our clients have been very professional. A lot of them, when we ask the question, have the package ready to go and deliver it, and then it's easy to review and just say, okay, this is fine. And then I think, the ones that would prefer not to ask those questions naturally would not seek out our financing anyway.
Yeah, thank you. Now I see we are right on time and we have 4 minutes left. So I would like each panelist to give their closing remarks. So, look at the historical facts and trying to predict the future. I would be interested to hear, now that 2023 is quickly coming to this fourth quarter, and how this year met your expectations, and if you have any crystal ball for shipping finance in 2024.
So I wish I had a crystal ball, but I think certainly for DNB, I think 2023 it has been a strong year. I think if I could think about what we might be talking about in a year from now, I think the easy answer is probably some of the geopolitical tensions that we've all seen over the past few years and sort of how that has impacted the markets in general. But I think actually the point I would expect to sort of focus on is really around capital allocation. I think especially in this sort of higher for longer interest rate environment, we talked about this earlier, but when you have strong cash flow, free cash flow generation, strong balance sheets, largely across the various sectors, especially on the public company side where there's special dividends, there's sort of fixed, stable dividends. I think that low leverage strengthening of the balance sheet that we've seen over the past couple of years, I think it will be interesting to sort of see how that plays out in a higher for longer interest rate environment.
That was also a good year for us. We'll do 25, maybe a few more transactions. We'll even add about 700 million of new business. So I'd love to. So that's not big for some of the large institutions, but for us it's quite good. We're a team of less than 15 people. So we're going to keep doing what we're doing, focusing on the asset type, dry bulk, container, tankers, and on a core group of clients. So do some moderate growth with them and hopefully add a few more. So if we see an opportunistic chance like the HSBC portfolio, very pleased to look at that. In terms of how we react to the markets, I think the markets have been firmer where we focused than we expected, and it looks like it may maintain that way for a few months longer. Okay, and everybody, I'm sure there'll be a container panel where people will predict when it's going to soften, but that's going a few months further into 24 than people expected. So we watch for that because for us, visibility of cash flow and how we're going to get repaid is important.
I think we will continue doing what we've been doing, developing good relationships with the lenders, advising ship owners on a variety of structures. The tendency has been towards more new building mandates over the last year, both on offshore side as well as PCTCs and container. I think that will continue. We've also put together a mezzanine product where we can then offer that directly to the LPs of funds. So I think that is also an area where we can grow more in the coming years. In terms of looking sort of ahead on how things can develop, I mean, we have a funny timestamp from last year at this conference where the panel was asked how the inflation would influence business. I think I was the only one saying that the inflation would have an impact on the business. The banks back then said it wouldn't really matter that much. On going forward, I think the banks will probably see more headwind. I mean, the real estate has started to touch European banks. That will only continue in the coming year, I think. And private capital coming in and competing with banks who have variable components, you will have large private equity pockets favoring the debt side, seeing that they can have better risk-protected returns there compared to the equity side. So I think that's only going to grow as we remain in this environment with higher for longer interest rates.
Yeah, I think this year has been a record for us. We've seen about $8 billion in new opportunities. And, you know, I think going forward, especially with higher for longer interest rates, the gap between non-bank and bank capital is significantly lower than it was several years ago. So we expect the non-bank market to continue to grow, and we're not looking to grow our portfolio exponentially, but we do believe we're well positioned to continue to expand.
Thank you all, and we are right on time. And thank you, Andrew, Evan, Erlend, Jason, for your valuable insights. Thank you, Nicholas and Capital Link. Have a wonderful day.